All right, let's talk about one of the most important investing books ever written. Benjamin Graham's The Intelligent Investor. Now, this isn't some get-rich-quick scheme. Nope. This is all about building real, lasting wealth using a smart, disciplined philosophy. Let's dive in.
So here's how we're going to break this down. First, we'll see the problem Graham was trying to solve. Then we'll hit his 3 main pillars of wisdom. And finally, we'll talk about how you can actually use these ideas yourself.
Okay, so to really get what Graham did, you have to picture what Wall Street was like back then. It was basically a giant, chaotic casino. People were making huge decisions based on rumors and gut feelings, not on logic.
And this quote just nails it, right? Investing was more like an art form, full of superstitions and pure guesswork. There was no real system, which meant most people were just riding a roller coaster of market swings and hoping for the best.
And then in walks Benjamin Graham. See, he saw the absolute devastation of the 1929 crash up close, and he made it his life's work to create a framework, a system that could protect regular people from that kind of financial ruin. He was about to bring some science to the madness.
So that brings us to Graham's very first pillar. And honestly, this might be the most important part of his whole philosophy. He said you have to know, without a doubt, if you are investing your money or if you're just gambling. And believe me, they are not the same thing.
This really lays it all out. You see, an investor, they're buying a piece of a business. They do the research. They care about its real value. A speculator, on the other hand, is just betting on which way the stock price is going to move. One is a business owner, the other is just playing the odds at a casino.
And here it is, Graham's famous definition. Let's really pull this apart. Thorough analysis, that means you did your homework. Safety of principle, that means you're not likely to lose your shirt. And adequate return means you're aiming for a solid, reasonable profit, not some lottery jackpot. If it doesn't check all 3 of those boxes, Graham says you're speculating, not investing, period. All right, so you've decided you're an investor. Great. Now what do you do when the market goes completely haywire? Well, this is where Graham's second pillar comes in, and he explains it with one of the most brilliant analogies you'll ever hear in finance.
He wants you to meet Mr. Market. Imagine he's your business partner. The only problem? He's emotionally unstable. We're talking wild mood swings. And every single day he comes to you and offers to either buy your shares or sell you his.
On his good days, Mr. Market is just on top of the world. He's euphoric. He thinks the business is going to the moon, and he'll offer to buy your shares for way, way more than they're actually worth. This is your classic bull market bubble.
But then, on other days, total panic. He's convinced the sky is falling, he's desperate to sell, and he'll offer you his shares for pennies on the dollar, just an absurdly low price. This is your classic bear market panic.
So here's the secret weapon. You don't have to listen to him. You don't have to play his game. The intelligent investor just uses his moods. When Mr. Market is in a panic and offering you a fire sale, you buy. And when he's giddy and offering you crazy high prices, you can either sell to him or just ignore him completely. The key is to let his emotions serve your goals, not the other way around.
And that brings us to the third and final pillar, the one that really holds everything else up. Graham himself called this the 3 most important words in investing. And it's your ultimate shield against mistakes, bad luck, and the madness of Mr. Market.
The margin of safety. It's basically your financial seatbelt. It is the simple but incredibly powerful idea that you only buy something when you can get it for a lot less than what it's truly worth. That gap between price and value is your cushion. It's what protects you if you're wrong or if the world throws you a curveball.
This table makes it super simple to see. Let's say you do your homework and figure out a company is really worth about $100 a share. That's its intrinsic value. But because Mr. Market is having a bad day, he's selling it for just $60. That $40 difference, that is your margin of safety. It's your buffer, and it's where your future profits come from.
Okay, philosophy is great, but how do we actually do this? How do we put it all together? Well, Graham didn't just leave us with big ideas. He gave us a clear roadmap, especially for the everyday person he called the defensive investor.
Graham laid out some pretty clear rules of the road. First, you gotta diversify. Don't put all your money in one place. Second, stick with the big, stable companies that have been around a while. Third, look for a long history of paying dividends. It's a sign of financial health. And last but not least, always, always demand a margin of safety. Never overpay.
And that really gets to the heart of the intelligent investor.
Graham's ultimate lesson was that the greatest danger to your portfolio isn't a bad economy or a stock market crash. No, the biggest threat is you. It's your own fear, greed, and impatience. So the real question isn't about outsmarting the market. It's about mastering yourself.